Now speaking, Doug Clark, Vice President, Investor Relations. SentinelOne reported strong first quarter earnings results, with total revenue reaching $50.3 million and a gross profit of $45.6 million. CEO Tomer Weingarten noted that the company saw record growth in its customer base and highlighted the strong performance of its subscription business, which was up 57% year-over-year. Additionally, he emphasized the importance of their cloud security solution, which saw a 90% increase in sales over the same period last year. CFO Dave Bernhardt provided guidance for the second quarter and full fiscal year 24, forecasting total revenue to be in the range of $51.7 $53.7 million and $214 $217 million respectively. He also noted the company's long-term financial targets, including achieving a 25% operating margin by FY25 and 70% plus gross margin by FY26. The call concluded with investors being reminded that any forward-looking statements made during the call were as of today and may not contain current or accurate information. Now speaking, Tomer Weingarten, Chief Executive Officer. Summary: during the first quarter, the company saw strong revenue growth and margin improvement. Customer retention and expansion remained strong, with most of the Fortune 10 now using their best-of-breed platform. Despite this success, external market dynamics caused top-line growth to be lower than expected. In response to this, the company is taking actions to fortify their business by optimizing costs. They are also focusing on go-to-market execution, which includes a one-time adjustment to their ARR. In Q1, they delivered 70% revenue growth, achieved record gross margins, and expanded their operating margin by 35 percentage points. However, macroeconomic conditions have led to smaller deal sizes and longer sales cycles, causing some deals to slip to the next quarter. As a result of this, they are expecting full-year revenue to grow 41% at the midpoint. Now speaking, Tomer Weingarten, Chief Executive Officer. SentinelOne is a leader in AI-based cybersecurity solutions, with a focus on endpoint cloud, identity, and data. In Q1 2021, they added more than 700 new customers, taking their total customer count to over 10,680, and achieved record gross margins. They also added a Fortune 10 customer and now serve half of the Fortune 10. Despite budgetary pressure from the current economic landscape, their ARR per customer increased by more than 20 percentage points year-over-year, demonstrating their success with both large enterprises and mid-market adoption of their platform offerings. Their land and expand strategy has been successful, as customer retention and expansion remains resilient. They are continuing to maintain a balance between growth and profitability by streamlining their business through workforce optimization, cost discipline, and focusing investments on core products. Their AI-based detection engine continues to be a differentiator in the market, and recently launched Purple AI supercharges users to control all aspects of enterprise security. They believe their approach will lead to a paradigm shift in enterprise security and operations, allowing them to capitalize on a $100 billion addressable market composed of legacy solutions ripe for disruption. Now speaking, Dave Bernhardt, Chief Financial Officer. Tomer provided an overview of the quarterly financials and updated guidance for Q2 and fiscal year 24. A one-time adjustment to ARR was made to provide a cleaner view of growth going forward and to correct historical recording inaccuracies. In Q1, revenue grew 70% year-over-year to $133 million, with international revenue representing 35%. Net new ARR was $42 million, ending the quarter at $564 million. Gross margin improved to 75%, up 7 percentage points YoY. Operating margin improved to negative 38%, up 35 percentage points YoY. Free cash flow outflow decreased to $31 million from $55 million in Q1 of last year, resulting in a 46 percentage point improvement. For Q2, SentinelOne expects revenue of $141 million, up 38% YoY, and net new ARR in the low $40 million range. The full-year outlook is for revenue of $590 million to $600 million, growing 41% at the midpoint, and ARR is expected to grow in the mid-30% range. Gross margin is expected to be 74% to 75%, up over 2 percentage points YoY, and operating margin is targeted between negative 29% and negative 25%, an improvement of about 22 points YoY. To optimize long-term market and growth potential, workforce reductions and cost optimization actions are being implemented, leading to expected cost savings of $40 million once fully executed. JP Morgan Chase & Company analyst Brian Essex inquired, question, could you explain the products related to the slowdown in consumption usage, and how that impacts forecasting of ARR revenue? Dave Bernhardt replied, the $27 million one-time adjustment is a 5% reduction of our ending ARR, due to a change in methodology for calculating ARR on certain usage and consumption-based agreements. This accounts for single digit of our total ARR and reflects customers reducing their spending to get back to the committed contract value. We implemented this to reduce quarterly ARR fluctuations, better correlate ARR and revenue, and adjust external expectations of future revenue. This doesn't affect historical bookings, cash flow, or the income statement. However, we have fixed an error in our CRM related to upsell motions, including renewal terms. JP Morgan Chase & Company analyst Brian Essex inquired, how can an enterprise manage their security posture while minimizing the amount of data they ingest and store, and what is the risk/cost trade-off of that decision? Tomer Weingarten replied, we're seeing customers take a more prudent approach to what they store in log analytics. They are filtering out data they don't feel is useful, which has led to downsizing and right-sizing of logs. This is happening with us and other vendors. We decided to remove the consumption part from our ARR to avoid potential volatility in the future. The same is true for security data where customers are scrutinizing what they put into the platform. Bank of America Merrill Lynch analyst Tal Liney inquired, can you explain the discrepancy between the Q1 contract slippage and the reduced second quarter guidance and full year guidance? Additionally, why are you reducing workforce and other expenses if this is only slippage? Is the situation worse than initially thought? Is there greater loss rate of contracts or competition that impacted the reduced guidance? Tomer Weingarten replied, in short, we've identified 3 primary factors for why we're taking a more prudent approach to our guidance. These include, 1. Some execution hiccups on deals that were not supposed to slip, 2. Customers not reflecting what they intend to buy in the beginning of the deal, and 3. Us not counting consumption as part of our ARR but only as upside. The competitive environment has remained consistent with our win rate stabilized over the past few quarters and no noteworthy changes. Dave Bernhardt replied, to build on that, we have implemented cost initiatives to ensure we reach break-even or better this fiscal year. We've sharpened our pencils and taken action to achieve our bottom-line goals despite the revenue and ARR expectations for this year. We've made smaller cuts earlier and more significant cuts in the last week in order to prepare us for the long term. Barclays analyst Saket Kalia inquired, Tomer, could you provide us with an analysis of how your product fares against Microsoft's competitively? Tomer Weingarten replied, Microsoft is a powerful competitor, but their security portfolio isn't on par with what a specialized vendor can provide. When customers are looking for specific security capabilities, Microsoft is not always the best choice. For example, cloud security is an area where we have seen triple-digit growth year over year. Additionally, we believe the addressable market for our offerings is around $100 billion and Microsoft's revenue in this space is only a fifth of that. We remain confident in our ability to compete against Microsoft due to our automated, Apex-driven solutions and partnerships with security-savvy professionals and MSSPs. Raymond James analyst Adam Tyndall inquired, Tomer, could you explain what steps you are taking to ensure that the negative surprise in data ingestion does not indicate broader challenges in the business? Tomer Weingarten replied, GRR remains stable and customers don't churn. When right-sizing of licenses occurs, it is not material for us. Consumption, however, is more volatile. When companies are under pressure to save, they might consider data consumption. Our multi-year contracts with customers are tied to number of people in the organization and remove some of the volatility associated with data volume, which is why we removed it from our ARR projections. Raymond James analyst Adam Tyndall inquired, Dave, what is the size of Scalyre's consumption business and have there been any changes to its contractual basis? Dave Bernhardt replied, the single-digit percentage of total ARR is stable, and we're taking steps to ensure that it remains so. We're making sure our contracts are structured in a way that eliminates any fluctuations, while remaining conservative with our estimations. Scotiabank analyst Lori Luo inquired, could you please tell us how the cloud security product performed this quarter, and if there are any updates on the partnership with Wiz? Tomer Weingarten replied, yes, we have seen great growth in our cloud business this quarter with ACV representing triple-digit growth year over year. Our partnership with Wiz has been beneficial for us, resulting in more pipeline movement from our existing customers and new shared opportunities. We have tightened up the technical integration portion of it and all signs point to further progress. Our cloud security campaigns and Salesforce are maturing, allowing us to transition from an endpoint company to a platform company in the cloud. This is the tip of the spear for us. Morgan Stanley analyst Hamza Fodderwala inquired, Dave, could you please confirm if the $40 million in cost savings from the 5% workforce reduction is reflected in the full-year guidance? Also, would you mind reaffirming the expectation for free cash flow break-even exiting this year? Dave Bernhardt replied, we're expecting to deliver $40 million in cost savings relative to our prior plan, which will help us reach our full-year EBIT guidance. This includes about $15 million in annualized savings, with $3.5 million in severance costs, inventory write-offs and other facilities-related expenses. As a result of the lower top-line expectations for the year, we anticipate that free cash flow target will be achieved in fiscal 25. Wolfe Research analyst Josh Tilton inquired, when did you first notice the slowdown in business and the issues with the ARR disclosure? Tomer Weingarten replied, generally, we noticed a shift in consumption at the end of the quarter which, coupled with a few deals slipping, resulted in a different outcome than anticipated. Our new and upsell target for the quarter was in line with expectations, but the downsizing of consumption had a major impact on our results. If you exclude that element, our win rates and revenues were still growing at 70%. We were surprised by the magnitude of the shift, which is where we stand today. Dave Bernhardt replied, we conducted a deep dive into our ARR and discovered an error in our CRM that had resulted in an uplift to our expectations. We found that we were stacking upsells on top of existing renewals without removing the previous renewal. This was identified post-quarter and corrected. This explains the shortfall in revenue. TIG analyst Gray Powell inquired, what was the primary factor behind missing Q1 revenue guidance of $137 million? How can we be sure this won't happen again? Tomer Weingarten replied, the ARR adjustment we made was due to consumption no longer driving up our ARR as it had in the past few years. This created an expectation for revenue that wasn't realized when the quarter ended, and CRM inaccuracies further impacted the revenue mix. Outside of that, the ARR for the quarter was roughly in line with expectations, minus the reduction in consumption. All in all, these issues have been addressed and should not happen again. Deutsche Bank analyst Brad Zelnick inquired, what is your strategic endgame in the face of a hostile macro environment and increased competition? How do you envision the business progressing over the next few years given these conditions? Tomer Weingarten replied, it's clear that we are here for the long term. We have a $100 billion TAM and cutting-edge technology. Our margin progression has been impressive, so we are becoming increasingly efficient. We're not looking to just put the pedal to the metal, but rather become more disciplined in our growth. We're continuing to add customers and are leaders in AI, which is poised to disrupt the cybersecurity landscape. Overall, I'm confident our shareholders will see the opportunity this presents. Dave Bernhardt replied, if you look at us on a 3 to 5 year horizon, our goal is to be a profitable and growing company. We remain committed to technological advances, leveraging our leadership in cybersecurity to capitalize on a long runway of opportunities for growth. Guggenheim Partners analyst Ray McDonough inquired, can you provide clarity on the gross retention rate given customer right sizing and how the headwinds for renewals, expansion, and new logos are affecting company growth? Dave Bernhardt replied, our NRR rate has decreased from 130s to above 125, indicating customers have increased their spend with us year over year. We expect this trend to continue. We're forecasting a minimum of 120% growth in the foreseeable future. Our GRR has been relatively flat for the past 8 quarters and our customers tend to stay with us once they start using our services. We're noticing that customers are flattening out their deals based on employee count and only coming back to us at renewal if they're purchasing larger amounts. This is impacting our forward projections from customers compared to what we previously saw. Tomer Weingarten replied, our gross revenue retention, GRR, remains stable and is what we refer to as planned GRR. We previously had lower GRR than planned, but this cannot be taken for granted in this environment. Our NRR is among the highest in the industry and we anticipate that will continue.